On a Wednesday morning in August 2019, a company filed a document with the SEC. It was meant to make its founder one of the richest men in America. 49 days later, that founder was gone. The company had lost $38 billion in paper value, and the investor who had bankrolled the whole thing was sitting in Tokyo, wondering how he'd been so wrong. WeWork was not a tech company. It owned no proprietary software. It held no patents that mattered. Its product was a desk, in a room, in a building it didn't own. And yet in January 2019, SoftBank's Masayoshi Son agreed that WeWork was worth $47 billion, more than Ford, more than Target, more than every airline in America except Delta. The man who convinced him was a 6'5" Israeli former naval officer named Adam Neumann. Neumann did not have an MBA. He did not have a finance background. What he had, by every account of every person who met him, was the most powerful presence anyone had ever encountered in a pitch meeting. This is the story of how a co-working company became the most expensive cautionary tale in the history of venture capital. And it begins, as most disasters do, with something that worked. In 2008, Neumann and his architect friend Miguel McKelvey opened a place called Green Desk in a half-empty Brooklyn warehouse. They rented the building from the landlord, divided it into small offices, and rented those offices to freelancers and tiny startups. The idea was not new. Serviced offices had existed for 50 years. Reeves, the British competitor, was already a public company with thousands of locations, but Neumann and McKelvey had stumbled into a moment. The financial crisis had just created a generation of involuntary freelancers. The iPhone had just created a generation of remote workers, and nobody in commercial real estate had noticed. By 2010, they had sold Green Desk and opened the first WeWork in Soho. By 2014, they had 32 locations. By 2016, they were in 14 countries. To understand what came next, you have to understand the actual business. WeWork's model rested on a simple arbitrage. The company signed long leases on entire floors of commercial buildings, often at a discount because they took the whole space. Then, they spent $200 to $400 per square foot on renovations, exposed brick, glass partitions, kitchens stocked with cold brew. Then they rented that same square footage back to individual members and small companies, by the desk and by the month at a premium. In a mature building running at 85% occupancy, the unit economics worked. A floor that cost WeWork $40 per square foot per year in rent could generate $120 per square foot in membership fees. The difference, minus utilities, minus staff, minus the renovation amortization, was profit. The growth was real. The demand was real. WeWork's spaces were genuinely nicer than Reeves' spaces. The kombucha taps and the free beer and the exposed brick. These things mattered to a 28-year-old engineer choosing between two co-working memberships. But there was something else too. WeWork sold a feeling. Members were called members. The buildings hosted yoga classes, networking events, weekly happy hours. The mission statement, printed on the walls of every location, was to elevate the world's consciousness. For a generation that had watched the social contract dissolve in 2008, the offer of belonging, even at $30 a day, was easy to underprice. Landlords loved it. WeWork signed 15-year leases at full market rent, sometimes above market. They took spaces nobody else wanted, odd floors, awkward layouts, second-tier buildings, and filled them. By 2018, WeWork was the largest private occupier of office space in Manhattan. It was the largest in London. It was the largest in central Washington, D.C. WeWork understood the new economy better than the incumbents did. That much was true. And then came Masayoshi Son. In 2017, Son met Neumann at SoftBank's New York office. The meeting was scheduled for 2 hours. According to Sun's later telling, he made up his mind in 12 minutes. He wrote a check for $4.4 billion. That single investment changed everything. Not because of the money, though the money mattered. It changed everything because of what Sun said to Neumann on the car ride afterwards. He told Neumann, in his own words later confirmed in court documents, that in a fight, the crazy guy wins. He told Neumann to be crazier, to go faster, to think 10 times bigger. Neumann took the note. What crazier looked like in practice was this. WeWork bought a wave pool company. It bought a coding bootcamp. It launched WeLive, a co-living concept where adults paid premium rent for dorm-sized apartments. It launched WeGrow, a private elementary school inside its New York headquarters, run by Neumann's wife, Rebecca. It bought a company that managed conference room bookings. It bought a stake in an artificial wave technology firm based in Spain. None of these ventures made money. Most of them lost money quickly. In 2018, WeWork reported revenue of $1.8 billion and a net loss of $1.9 billion. The company lost more money than it earned in absolute terms in a single year. The standard defense was that this was venture-stage growth investment. Amazon had lost money for years. So had Uber. So had Tesla. Losses were a feature, not a bug. But there was a difference. Amazon's losses funded warehouses and software it would own forever. WeWork's losses funded leases. This is the chart that explains the entire collapse. When WeWork rented a building, it signed a 10 or 15-year lease. When it rented a desk to a member, that member could leave in 30 days. WeWork's costs were locked in for a decade. Its revenues were locked in for a month. In a recession, the members would leave first, and the leases would still be due. By August 2019, WeWork had signed $47 billion in future lease obligations. It had $2.8 billion in cash. The company was, in the precise technical sense, a maturity mismatch machine, the kind of business that works beautifully until the moment it doesn't. Inside the company, the signs were everywhere. Neumann had bought commercial buildings personally and then leased them back to WeWork. A conflict of interest so naked that the S-1 had to disclose it on page 9. He had personally trademarked the word "we" and then sold it to the company for $5.9 million. After public outcry, he returned the money. He flew on a private Gulfstream that the company paid for. He served tequila shots at meetings, including the one where he announced a 7% staff layoff. When a director asked him in 2018 how the company would ever justify its valuation, Neumann answered, "Our valuation and size today are much more based on our energy and spirituality than it is on a multiple of revenue." The board laughed. They funded him anyway. The S-1 was filed on August 14th. It was supposed to be a coronation. Instead, it was an autopsy performed in public. Reporters and analysts spent 4 days reading the 383-page document. What they found became its own news cycle. The conflict of interest disclosures, the losses, the governance structure that gave Neumann 10 votes per share, the provision that, if Neumann died, his wife Rebecca would choose his successor. The expected IPO valuation fell from $47 billion to $20 billion, then to 10, then to a number nobody wanted to print. On September 24th, the board met. By then, even Masayoshi Son had turned. The man who told Neumann to be crazier now told him to leave. Neumann resigned that afternoon. The exit package, negotiated over several months and revised under public pressure, was eventually reported at around $1.7 billion in stock, credit, and consulting fees, though the precise figure shifted as terms were renegotiated. The IPO was withdrawn on September 30th. SoftBank wrote down its investment by $9.2 billion in a single quarter. Then the pandemic came. In March of 2020, office buildings in WeWork's largest markets emptied in a week. Occupancy across the company's global portfolio, which had been running near 70%, fell to below 50% by summer. Members did exactly what the S-1 had warned they could do. They left in 30 days. WeWork's costs did not move. The leases remained due. The new CEO, Sandeep Mathrani, an experienced real estate operator, brought in to clean up the company, spent the next 3 years in a slow-motion negotiation with landlords. He cut billions of dollars in lease obligations. He closed underperforming locations. He shrank the global footprint by nearly a third. It was a credible turnaround attempt, and by 2021, it had bought the company time. In October of that year, WeWork finally went public, not through a traditional IPO, but through a merger with a blank check company called BOEX Acquisition Corp. The deal valued WeWork at $9 billion, 1/5 of its 2019 peak. The stock opened at $10 a share. Within 18 months, it was trading for less than $1. By 2023, the company was issuing going concern warnings in its own quarterly filings. Mathrani resigned in May. The board explored every option. There were none. On November 6, 2023, WeWork filed for Chapter 11 bankruptcy. The $47 billion company was worth, on paper, nothing. And Adam Neumann. In August of 2022, 3 years after his departure, with WeWork's stock collapsing, the venture capital firm Andreessen Horowitz announced a $350 million investment in Neumann's new company. It was called Flow. It was a residential real estate venture. The pitch, in the firm's own words, was that Neumann would reinvent what it meant to live somewhere. It remains the largest single check Andreessen Horowitz has ever written to a founder. There is a temptation, when telling this story, to make it about Adam Neumann, the tequila, the Gulfstream, the trademark scam, the crazy guy who finally lost. But Neumann was not the bug. Neumann was the feature. Masayoshi Son did not invest in WeWork in spite of Neumann's recklessness. He invested because of it. Son's entire thesis, articulated in interviews, repeated in shareholder meetings, was that markets reward founders who refuse to behave reasonably. He wanted crazy. He paid for crazy. He got crazy. The deeper lesson of WeWork is not that one man deceived a market. It is that, for most of a decade, the market deceived itself. It mistook charisma for vision. It mistook growth for value. It mistook a real estate arbitrage with a 30-day cancellation clause for a technology platform. Every era of cheap capital produces companies like this. The names change. The structure does not. A founder with a story. A backer with conviction. A balance sheet that only works if growth never slows. And one day, always one day, growth slows. The cost, when it does, is borne mostly by the people who never got to vote. If this was useful, subscribe. We publish one of these every week. Next time, a company that invented the digital camera sat on the patent for 25 years and then declared bankruptcy in 2012. Kodak, coming Friday.